Hello and good afternoon, everyone. We'd like to welcome you all on to this month's event on how to achieve a tax-efficient and flexible shareholder buyout. It's great to host everyone today. If anyone has got any technical issues throughout the event, please feel free to contact us using the chat function. And we will be having a question and answer session towards the end of the event, so please feel free to post your questions in the Q&A box as we go through the event, and we'll pick these up and address them later on. My name's Carl Taylor, and also on the panel this afternoon we've got Jerry Surtees, who is a Chartered Tax Advisor here at Oldfield. Good afternoon, Jerry.
Good afternoon.
Good, so we're here this afternoon to talk about achieving a tax-efficient shareholder buyout. And the fact is that either completely or partially changing the ownership of any company can be an emotional experience for those involved. The numbers involved can be significant, and the tax pitfalls and the tax saving opportunities can be quite significant. So whether you're considering exiting a business or thinking about buying out a business partner, thinking about succession planning or maybe retirement, or thinking about incentivizing key management or looking to release cash, the key consideration is how you can do that in the most tax efficient way for both the exiting shareholder and for the continuing shareholders. And we're going to touch on that a bit later on in the event. And with the uncertainty around what's going to happen to capital gains tax rates if there's a change of government later this year, owners are looking to speed up their exit while the capital gains tax rates are favourable. And despite recent changes, capital gains tax rates do remain at very favourable rates at the moment, at 10 to 20%. And despite what politicians might say, there isn't any guarantee that capital gains tax rates are going to stay at that kind of level in the future. Can't be certain that they will. So this afternoon, we're going to talk about the scenarios where some form of exit might be required or desired. We're going to talk about the process for exiting a shareholder. We're going to talk about the best way to structure a deal once you've got an agreement for an exit. We're going to summarize and talk about the next steps and key actions. And we're going to have a Q&A session at the end to go through any questions you've got. So please do feel free to post any questions throughout the event. Be really glad to answer those. So to set the scene, what scenarios are there where some form of exit might be required or desired? So I've just got some scenarios here I'm going to run through. First one is exiting a business partner. So this is where someone wants to exit from the business completely. We had one the other day where one of the shareholders was comparatively young and was really wanting to push the business forward. And we had the other shareholder that was getting older, nearing retiring age, and the differing goals of the two owners got to the point where it was going to be beneficial for both of them and for the business if the older shareholder actually sold his shares and moved on, and the other shareholder was then able to push the business forward. So that was a complete exit situation. You might have a scenario where you're looking at succession to the next generation of management. So we've had this scenario come up a number of times where older shareholders are wanting to pass the baton on to a younger generation, and they want them to take more responsibility for taking the business forward. They want them to have a greater stake in the business as a result. Still might want to retain a certain shareholding themselves, but they're really wanting to pass the baton on, wanting to pass on more of the ownership of the business to those that are actually taking responsibility for running it and pushing it forward. Another scenario you might have is retirement. So that's like a bit of a step further from the previous scenario I just talked about, where a shareholder wants to just retire, completely pass on all their shares and move on to the next stage in life. An internal sale where an external buyer can't be found or isn't desirable. So you might have wanted to sell your business, but you might not have been able to actually find anyone external who wants to buy the business, wants to take it on. And you might not actually like the idea, or you might not actually be comfortable with the idea of selling out to an external third party and leaving the employees at the mercy of a new owner. So it might be there's a key employee or maybe a group of employees, such as your management team, or maybe existing minority shareholders that are actually prepared to take the business forward, and you might want to sell out to them instead. So it's like an internal sale. Incentivizing key management team. This is a bit related to the previous point. It's a bit of a step further where you might want to actually bring a management team or key people in as shareholders. You're incentivizing them to grow profitability and grow the value of the business. We had a situation the other day where a main shareholder, majority shareholder, really wanted to reduce his shareholding and bring two key people from the management team in as shareholders in view of them taking the business forward. And there was a partial exit required in that scenario. You might just want to release cash to pursue other interests. So it might be that you want to release some cash to invest in something else like property or other business interests. You might want to support family with house purchases, and some or all of your shares are sold to provide the funding for that. So now we set the scene with some of the scenarios where an exit of a shareholder in some way might be required. Jerry's going to talk us through the process involved in exiting a shareholder.
Thanks, Carl. So you might well be in one of the situations that Carl's just outlined. You might have made a decision to either part ways, exit or partially exit a shareholder, or you might be a shareholder who's looking to exit or retire in some way. So we can understand the reasons for this, why it's a good idea. Hopefully there's some willingness between the parties to discuss an exit route and look at what that might look like. How do you then bring all of that together into a deal that everyone's agreed on and that can then actually be delivered on? Well, in our experience, there's typically 5 steps that you go through. And there tends to be varying degrees of formality on this, depending on the nature of the deal and the nature of the relationships. If it's within a family business, there might not be a great deal of formality to it. If it's between third parties, there's likely to be more. However, in practice, you will still need to go through each of these stages. And it's important as well to involve your advisors early on in the process, because they'll have insights that will be helpful and valuable in terms of valuation and tax aspects and the structuring of the deal. So invariably, deals start with an assessment of value, so share valuation. So the selling shareholder clearly wants to know what they're going to get for their shares, and the purchasing shareholder or shareholders want to know how much they're going to have to pay. So that tends to be where it starts. Whereas between connected family members, you have to have an independent valuation to satisfy HMRC. It has to be on arm's length terms. But even between unconnected third parties, it's often a good idea to get that independent expert valuation. So you've got a kind of a definitive balanced starting position from an expert who's got access to all of the market data about what's going on in your particular sector and therefore the value of your business. So that's the starting point. Then you move on to negotiating the key terms. So this is really about the parties getting together, discussing what they think the valuation is, deciding what shares are going to be sold and for how much, and what the terms of that payout are. Is it going to be cash up front? Are you going to pay by installments over a period of time? And then the other commercial terms around things like, will the exiting shareholder remain on for a period of time as a director or a consultant? What capacity will that be? What will their roles? What will the roles change to, and so on and so forth. So that all enters the phase. Sometimes at this point it might be difficult to reach an agreement, and it might even be necessary to go for professional mediation to make sure that you arrive at a deal that's acceptable to all parties. rather than having kind of festering disagreements or just not getting anywhere, or even in an extreme case, having to go to court, which is never a happy outcome for anyone. That will then lead into the financing and kind of structuring of the deal. And this is where your advisors will come in terms of how the new shareholders are going to finance the payout. Are they going to introduce some personal funds? Are they going to take on some bank borrowing? Or what is often the case, will there be agreement to pay out of the company's cash reserves and or future profits? And how can, if we're using future profits that the company hasn't perhaps actually created yet, how do we make sure that everyone's comfortable and satisfied that the company will be able to generate those profits? Again, you need your advisors to be involved in this stage. It might involve drawing up a business plan and a cash flow forecast to give everyone confidence that that plan is actually achievable, and also clarifying the best tax and legal structure for the deal, which will, once you've got that framework in place, then you need to move to heads of terms. And again, the formality that attaches to these depends a little bit on the relationship. If it's a close family relationship, you might do this yourselves or with help from your accountants. If it's between third parties, normally it'll be drafted by a solicitor. In principle, it's a non-legally binding agreement which sets out the key terms of the agreement. And even if there's general agreement between the parties, we always advise this for various reasons. One, it formalizes the deal and forces everyone to get on the same page, and there's some agreement in writing before you've started the legal process. And secondly, it allows some details to be ironed out, including things like payment schedules and cost sharing and so on, that might not otherwise be thought about and might become stumbling blocks further down the line. So it makes for a smoother transaction. So that, having got heads of terms in place, the final step is really instructing the solicitors. This is where the rubber hits the road. This is where you're actually implementing the deal. But you can't do all of that. You can't do any of that until all of the above, if you like, is ironed out and sorted. And to find it works best where you've got a close relationship between your advisors, so they can talk to each other direct, the solicitors and accountants. So you don't end up being this kind of piggy in the middle trying to liaise between the two parties. You want them to be working together closely. So I'll hand back to Carl to talk about the best way to structure the deal.
Thanks, Jerry. So we really want to pick up on point 3 that you've been talking about there, the financing and the structure of the deal, as this is where there's lots of opportunities, and it's also where things can go wrong. It's where you can incur unnecessary tax costs. It's where you can end up with surprise bills, or you can end up just leaving money on the table at this stage if you don't do it in the right way. So we just want to talk about the best way to structure once you've got a deal. So if we take the first scenario we discussed at the start, where there's a business partner exiting, we've got an example situation here. Karen and Steve in business together, they're 50-50 shareholders, and Steve just isn't interested in the business anymore, and they've mutually agreed that it will be beneficial for them both to part ways, let Karen take the business forward, and we've actually completed a deal very similar to this recently. They've been through various stages of valuation. As Jerry's mentioned, they've had a proper valuation done to establish the value of the shares. And after some negotiation, Karen has agreed that Steve's shares are worth 750,000. So the big question then is, how does Karen finance this share purchase? Where will she get the money from to buy Steve's shares? She could use 750,000 of her own funds to pay Steve for his shares, or she could take out a private loan to fund it, or she could take a significant extra dividend out of the business to fund the payment to Steve for the shares. But in all of these cases, she would be using her own personal after-tax income to pay for those shares. And to get this level of funds into hands, she's likely to have to pay dividend tax at the highest rates. And doing a few calculations for her to get 750,000 out in her hands to be able to pay over for the shares, it's likely to cost around 460,000 in dividend tax to do that. And that's not the end of the story. Once that's done, Karen then pays Steve 750,000 for his shares, and then Steve ends up paying capital gains tax on the payout. So you end up in a situation where you're paying tax on tax. Karen's already paid 460,000 of dividend tax, and then Steve ends up paying capital gains tax on that. So you can see that it's not a particularly tax efficient option. And in addition, the whole point of the transaction is to secure the continuity of the business going forward. It's about ensuring the business has got a sustainable footing to move forward on. And it's really important that this exit can be achieved in a way that just enables the business to move forward sustainably going forward. So the route we've just outlined isn't tax efficient. It doesn't really align well with these commercial objectives of achieving a sustainable go forward plan for the business. So there's got to be better ways of doing this. And Jerry's going to talk us through that now. Firstly, just looking at it from the buyer's perspective, and then looking at it for the seller or the exiting shareholder.
So clearly you can see that from the tax costs of paying for this personally, that if we could use company funds rather than personal funds to purchase the shares, this is clearly going to be a much better option and significantly reduces the tax cost of the transaction. Is there a way of doing this? Well, in fact, there are a number of possible options for doing this. And things you might hear about might be a company purchase of own shares or an employee ownership trust, which can work well in some cases, but they tend to be a little bit less flexible. They can have credit rating implications and implications when it comes to a future sale of the business and so on. So what we've found over the years, we've done a large number of these transactions over the years, and what we've found is that in the majority of cases, the best and most flexible route is what we call a holding company buyout. So as you can see on the slide when it comes up, that this involves essentially forming a new company which is used to purchase the shares of your existing company and pay out the exiting shareholders. So why is this the best route? Well, it achieves a number of important things. Firstly, the payout comes out of company profits rather than personal money, and the seller just pays capital gains tax. Carl will touch more on that in a moment. Secondly, we can structure the payment to be made in instalments, and that's different to a company purchase of own shares, which you might hear talked about, which has to be done in cash on day one on completion, and that obviously creates limitations from a cash flow perspective. From a credit rating perspective, the holding company route has little or no impact at the point of exit. Again, unlike a company purchase of own shares, which tends to knock a bit of a hole in the company's balance sheet and impact credit rating as a result. The other thing is about this route is that the transaction can be structured to avoid having to incur a stamp duty bill, which can otherwise be a significant cost of a transaction on quite a valuable company. And this is a route that's available to us in the legislation, which many accountants are not aware of. So it's worth making sure that you're doing that in the most efficient way. So fundamentally, what we're doing is we're offering a flexible way for Karen to buy Steve out from his out of company profits, using company profits to buy him out, and that is the best way of reflecting the benefit that the company will gain through having the shareholding sorted and allowing Karen to take the business forward. So we sometimes get asked, is there a downside of this route? And I guess the reason why we're talking to you about it today is because it is a good route, it's a flexible route, and doesn't have doesn't really have any downsides. I suppose if there is one, it is just that it's a more involved and somewhat bespoke solution. You certainly can't do it yourself. Not a good idea to try and do it yourself. And you need to make sure that any advisor that you're asking to do this has got experience and the right level of expertise. It's also very important to make sure that you get HMRC clearance ahead of entering into the transaction. You want to be sure that HMRC are comfortable that it's being done for sound commercial reasons, and that's important to make sure that you do secure that favourable tax treatment. And you do need somebody who's got experience with how to structure the deal and present it to HMRC in the right way. And in fact, recently we saw a clearance that was rejected by HMRC because it was by another firm because it was essentially poorly structured. Technically, it could have worked, but there just wasn't really any reason for HMRC to give it the green light. It wasn't going to satisfy the commerciality tests HMRC were looking for. So thankfully, we've managed to adjust the way it was structured and reapply and get the clearance through in that case. But it just shows the importance of making sure that's being done in the best way. So that's given you a bit of an overview of how we see that solution working in practice from the buyer's side. I'll just hand you over back to Carl to look at this from the seller's perspective.
Thanks, Jerry. So where does that leave the seller? We've talked about the best route to look at from a buyer's perspective. Where does that leave the seller? Well, as things stand at the moment, the seller, the exiting shareholder, will pay capital gains tax at rates of between 10% and 20%. So 10% if you qualify for business asset disposal relief, or 20% if not. That's, a favourable rate of tax, especially when you consider the other tax rates there are in the UK. You think about things like the higher rates of dividend tax, 33.75% or 39.35%, or income tax at the higher and additional rates, 45%. In that context, capital gains tax rates of 10 and 20% are actually very favourable. And as you said at the beginning, there are timing considerations to think about here. Any kind of new government is likely to be a chance for capital gains tax rates or bans or the reliefs around capital gains tax to be reviewed or reconsidered. So taking advantage of the current favourable rates may well be a good idea. In fact, we're advising clients that are looking to do this to get on and do it ahead of a change of government. So if you're thinking about it, you do need to start looking at it now to make sure you can get a transaction completed ahead of the end of the year. Invariably, these things do take some time to actually happen. There's clearance to apply for and there's a legal transaction to do. So you can't leave it till the last minute. You have to start thinking about it now to ensure it's going to happen in time. So just going to summarize briefly and remember to hang on for the question and answers. We've got some interesting questions that we want to be able to answer. But just to summarize, as you can see from the points we've outlined, there's a good way to achieve a shareholder exit or buyout. And there's a way that will incur significantly more tax. So it's really important that you get it right if you're considering something like this. It's really important that you do it the right way, you get it right so that you minimize the tax liabilities and you make sure that the business can move forward on a sustainable footing. So if you're in any of these situations we've got on screen, please do come and talk to us. You might be in a situation where you want to exit yourself or someone else, or you've had some conversations about a possible exit, but you're not really too sure where to go next on it. You might have a deal agreed, but you're not quite sure how to actually take it forward. Or you might have had clearance refused from HMRC. You might have tried doing something like this, but not got anywhere. You might just be wanting to step back from the business. You might be handing over shareholding, and you might have to release cash, and you're not quite sure the best way to do that. Well, there'll be a link to booking a call with us on the follow-up email that will be sent after this event, so look out for that. if you'd like a conversation, just click on that link and get in touch to book a call in, or you can use the link which I've just posted in the chat right now. You can follow that link and get a call booked in. Just before we move on to the Q&As, just to mention we are running another event in May where we're going to be talking about using holding companies and maximizing benefit you can get from using holding companies in your company structure. So that's on the 22nd of May at 2:30. Look forward to seeing you on that event. So questions. Going to pick up on the questions we've got here. So let's have a look at this. So just got a question here. Can I get my own accountant to do this, Jerry? What's your comments on that one?
So I think you need to be sure that they've got the relevant experience and knowledge about of doing these kind of transactions. Absolutely, there's lots of firms out there that can do these type of transactions, but equally there's those that wouldn't have that level of experience and knowledge. Obviously, if we are your accountant and you're asking that question, then we're very happy to handle that process for you.
Good. So got some other questions coming in here. So can you use a holding company buyout method if you've already got a holding company in place that already owns shares in the trading company? So I think in answer to that one, simple answer is yes, basically. You agree with that, Jerry?
Yes, yep. And in fact, we've done that in a number of cases. It's quite possible to have introduce another company in the process to do that, and it's also possible to if you like, streamline the structure once the exercise is complete. So that's not a difficulty, and we've done it a number of times.
Yeah, that's good. Another question we've got here: what about gifting shares to a family younger generation? Which is a good question, and yes, that's perfectly possible to do. Straightforward thing to do, largely, but the person gifting the shares isn't going to realize any value. They're just going to be gifting them and giving all the inherent value that's in those shares away. And so it's just a question of, is that what you're trying to achieve or want to achieve? Or do you want to realize the value that's in your shares and actually extract some cash in the process? Anything to add to that, Jerry?
No, I think that's an important point you make. It can be done between family members essentially as a tax neutral exercise subject to filing an election. But before you do it, I would encourage you just to think about whether you might be missing an opportunity to actually release some capital, some of your hard-earned capital over the years out of the company in the process.
That's good. Another question here: how do we approach it if a shareholder that's exiting wants to remain a shareholder holding company that owns a premises, but wants to exit from the trading company? And I guess this kind of scenario we do come across sometimes, don't we, where somebody wants to kind of get out of involvement in the trading company, the actual trade that's going on, but maybe wants to retain some interest in property. Don't know what your thoughts are on that, Jerry.
Yeah, that's right. And again, we've done, quite a number of transactions along those kind of lines where you're essentially using the holding company structure to buy somebody out of the trading company, but they're retaining a stake in the property that's in the holding company. And there's more than one way of doing it, but I think the simple answer is yes, that is perfectly possible to do.
Good. Another couple of questions here. What if structure changes cause problems when it comes to selling? Would a buyer be put off by a complex structure? How would it work in a sales scenario? Don't know if you've got comments on that one, Jerry.
Yeah, I mean, I think the answer to that question is I don't see it should be a difficulty. Um, the Yes, if you've got a holding company, they're going to be acquiring an extra company, but corporate buyers and PE and so on are used to these kind of structures, holding company type structures, and it wouldn't be uncommon for them to acquire a group that's got more than one company in it at all. Have you got anything else to add to that?
No, I think that's good. I think got another question here. Can you sell your shares over a set time? So time frames is an interesting one, isn't it? And I guess that's one of the things about using a holding company buyout structure is that you can spread the actual cash payments over a period of time. You can pay in installments, however that's agreed between the exiting shareholder and those that are carrying on. Any other comments on that one, Jerry?
No, I think that's relevant what you said. It depends a little bit. I think what's behind the question, and perhaps need to maybe talk a little bit more one-on-one to understand what's behind that particular question. But there's more than one way of staging it actually. Um, but I think that's one of the benefits of this structure is it allows us to do that more staged approach rather than it being a sort of an all or nothing cash on day one sort of arrangement.
Exactly. Good. Any other particular questions you want to answer, Jerry?
Um, so I think there's one here about using growth shares to incentivize a shareholder as an alternative to buying out a shareholder, where you want to incentivize a shareholder where shareholders are equal. And I think certainly that's possible. Yes, it's possible. Yes, we've done things like that in the past. I suppose you've got to look at what your objectives are, and if your objective is incentivizing a shareholder, and that's the main driver behind this, then growth shares might well be the best route to go down. There are other ways of structuring that as well, which we could talk to you about. The holding company route is what this is about is kind of both sides of the fence, if you like. One part is increasing their shareholding, and another part is realizing some of their capital that they built up over the years. Whereas growth shares won't allow the reducing shareholder to actually release capital. So I think that's probably the key difference between the two routes.
Excellent. Good. Thanks very much. I think that wraps up the questions and answers. We've come to the end of the time, but if anyone's got more specific questions or wants to discuss anything that they feel hasn't been answered, please do register for or book in a call with us, and we'll be able to talk about it in more detail, give us some direction about where to go next on a call. So look out for that link on the follow-up email. Thanks very much for joining, everyone.
Thank you.